Hello students. Today we will talk about startup registration and what are the different company structure available for you to incorporate your company when you have decided to launch your startup or product in the market. So let us begin. In order to register as a startup, the first step you need to go is you need to incorporate your company. You need to have a legal identity or entity of your company. So you need to go for company incorporation or registration, and then after incorporating a company you need to go for registration of a company as a startup, and this can be done with Startup India, DPIIT, Ministry of Commerce and Industry, Government of India. Now normally startup india startup can only be company can only be recognized as startup if a company has 5 conditions being satisfied. I'll tell all of these. Number one, if the company is either incorporated in private limited, registered partnership firm, or limited liability partnership. So if you have these 3 type of incorporation, you are eligible for getting recognition as a startup. Then the company's age should not be exceeding 10 years. Okay, so when you're applying for a startup, at that point of time, the company should not be more than 10 years of old. Then annual turnover. Since the incorporation of the company, your company should have not crossed turnover of more than 100 crore rupees in any of the financial years when you're applying for a startup. And innovative and scalable factors. So company should be involved in development of innovative products and services or the processes, and involved in themselves into highly scalable and having high potential of employment creation and wealth creation, right? And then finally, it should be original entity. The company should not be formed by splitting up or reconstructing the existing entities or businesses, right? So if any company that satisfies all these 5 conditions, you can apply for Startup India, and the Startup India DPIIT will offer you a certificate as a startup. So that from that day you are considered a startup in India, right? So let me now talk you about what are different company structures available for you to register your legal entity, which is the very first step before going for startup registration. So in the very first step, normally the Startup India accepts 3 kind of categories. One is private limited, second is LLP, third is partnership firm. So now I'll tell you what are the differences in all these 3 formats with some parameters, and then you decide what company structure is best suited for your startup. So first thing we will see is the minimum number of directors. So in a private limited company, you should have minimum 2 directors. That means 2 person leading the company. Also in limited liability partnership, you should have 2 directors, and also in partnership firm, you should have two directors. Minimum 2 directors. You can have more than 2, but at least you should have 2. See, all these names you see: private limited company, limited liability partnership, and partnership firm. They are different company structure, a legal entity altogether, right? So don't get confused in this, nothing much. Your CA, the chartered accountant that you hire, will register the company for you. But as a founder, you should have some basic understanding about what the structures are all about and which structure is suited for you. So that's why I'm sharing this information with all of you. Shareholders. Now, shareholders are the one who owns the company basically. So in private limited company, you can have 2 shareholders. So these people can be same as that of directors, and this can also be different than that of directors, right? So directors are the one who runs the company, who takes the decision of the company, right? But shareholders are the one who have invested, who owns the company. So many times investors that put in money into the company, they are not directors of the company. So they are the shareholders basically. They invest into the company. They are liable to get all the benefits that company would have got when the company is growing, but decision making power is not there with the shareholders mostly. In case of limited liability partnership and partnership firm, LLP and partnership firm, the shareholders are not there differently, which means by default the directors are shareholder in both the cases, and in partnership firm also the directors are the shareholders. So you cannot have different shareholders, which means taking an investment into this company is very difficult. That's why all the investors, private investors that put in money into the private limited company, they always put into private limited structure. They don't go for investment into LLP or partnership firm, right? Because by default the owners are the directors, and when you are raising the third party money, they want the shares of the company. Then authority. So who is governing these structures? So for private limited company, MCA, Ministry of Corporate Affairs, which is under Government of India. This is centrally managed. Again for LLP, it is Government of India, Ministry of Corporate Affairs. And partnership firm is managed by ROF, Registrar of Firms, and this is different for each state. So Gujarat has a different ROF, and then other Maharashtra will have a different ROF. So this is governed by the state government, right? Name. In a private limited company, your name will end with private limited. So let's say if your name is XYZ, so you can name as XYZ private limited. In case of LLP, you will also have ending with LLP. So XYZ LLP is the name. And in partnership firm, there is no such ending point. So you can just have any name for a firm. Name security. In a private limited company, when you registered the name, let's say Jay Sudhani Private Limited, so nobody in India can register a company on the same name, Jay Sudhani Private Limited. Why? Because that is secured, and MCA will not approve that. Same way LLP. In case of LLP, also your name is secure 100%. In case of partnership firm, there are chances where people can have the same name for the same business or a different business, right? So security in partnership firm of name is not there as such. Limited liability. Now this is very, very important parameter. I want you to understand this. In case of private limited company, you are having limited liability, which means, let's say in this case, a company is treated separately as a separate legal entity, and you yourself is treated separately. Say for example, I am running a private limited company and I have raised investment of 25 crores. I have done expenditure, and then I have taken a loan, let's say banks debt funding from bank, and then suddenly I went bankrupt, which means I am at a point where I'm shutting down my business or a company. Now, when you are running a private limited company, which means whatever resources or assets that the company have in the name of private limited company, those assets are only at risk. Your private assets like your own house, your own vehicle, your own car, your own asset which are on the name of Jay Sudhani will not be at risk at all. So the government or anybody can only seize the assets which are in the name of a company and not in the name of individual person. So here you are the liability is limited. That's why it is called limited liability in private limited company. So you are treated as a different entity and the company is treated as different entity. So in that way you are safe a bit. Also in the LLP, the same benefit will have. You have limited liability, which means whatever resources of company, they are at risk, not your own resources. But in partnership firm, you also have to pay back the loan or the resources out of your pocket as well, which means in your individual capacity as well, right? So that's the issue with partnership firm. Credibility wise, credibility of private limited is the highest, which is normally known to be one of the strongest incorporation, then moderate for LLP, and lower for partnership firm. So if you are running a business and if you say that your startup has to expand horizons of different states and then you want to operate at a national level, I would suggest go for private limited, which has highest credibility in the sense. Public documents, your customers, your clients can easily view your documents online with MCA portal. They have a dedicated portal wherein they can look at the information of the company. So that way it is very authenticated. So people trust the private limited company. Also LLP has the same thing, but there is no online portal or documentation available for clients and customers to view your partnership firm. So people may doubt that the firm is existing or not. What are the main documents? For a private limited company, the main document would be, first is certificate of incorporation. Government of India will issue a certificate to you as a private limited company first. Then you have MOA and AOA, Memorandum of Association, Article of Association. These are two major documents wherein you have written all those guidelines that what is this company incorporated for, how it is going to be operated, and what kind of product services the company is going to offer, everything. So these are the main document for private limited. Now main document for LLP is certificate of incorporation and the LLP agreement. You will have an agreement of LLP. In case of partnership firm, you just have partnership agreement with you. That is the main document of incorporation. Setup cost, we will see what does it cost. It takes around 8,000 to 15,000 rupees to establish a private limited company. Normally, the chartered accountant office, CEO office will register the company. It takes around 7,000 to 12,000 rupees for registering the LLP, and it just takes 3,000 rupees to 8,000 rupees to register the partnership firm. So Ideally, the cost of incorporation of private limited is highest because it has many more documents to be submitted. Audit, statutory audit. For private limited company, it is compulsory to have statutory audit once in every year, which means you need to submit all the data of your company once in every year to the MCA, and your CA normally does this process. Even if you are having a transaction or not, it is irrespective of that, you need to do this audit every year. In limited liability partnership, this audit is not mandatory. You are supposed to do the audit only if your transaction exceeds 40 lakh rupees, the turnover exceeds 40 lakh rupees, or the contribution by any promoter or funding exceeds 25 lakh rupees into your company in that particular financial year. In partnership form, there is no statutory audit as such. Only tax audit is required, which is also required for private limited and LLP both. CA. For a private limited company, CA is compulsory. You need CA to manage those compliances. In also LLP, you need the CA. And for partnership firm, it is your choice. You can also, abide by the compliances of ROF, provided you acquire sufficient knowledge, but there is no mandatory requirement of CA. Annual compliance cost. So the earlier cost which we saw was the cost of incorporation one time. Then every year, how much is the recurring cost? So when you hire a CA for your services or the compliances, normally they charge somewhere around 10,000 rupees per year. LLP, the charge would be somewhere around 5 to 8,000 rupees per year, and for partnership firm it is somewhere around 3,000 to 5,000 rupees because they only need ITR filings. Taxation. For a private limited company, after excluding all the expenditure, the profit that you have left over, the income tax on the company is 25% of the profit that you are earning, provided turnover is less than 400 crores. In case of LLP and partnership firm, it is a flat taxation, which is 30% across whatever turnover it may be. So 30% of the profit that you have earned in that particular year, you need to pay taxes of 30% of the same. So let me tell you which company structure do you choose out of these three. I'll have some suggestive guidelines. You can decide on your own. So if you are going for private, you can go for private limited only when you see that you have a long-term vision, you are clear about your startup idea. In future, you are looking to raise funds from private investors. Without that fundraising, you will not be able to operate a startup. So if that is in mind to raise funds from private investor in future, you go for private limited. And you feel that you would like to build a strong and credible company at the end, then you should go for private limited. When you should go for LLP, limited liability partnership. If you want all the benefits of limited liability, name security, credibility and others, but want to spend little less than private limited in setup and compliance costs, then you should go for LLP. You can go for LLP if you're not looking for raising fund from investors in near future. In registered firm, you can go for registered partnership firm if you're operating on a lower budget. If your bonding between the partners is very, very strong, this is very important. See, in a registered partnership firm, both the directors are associated and their individual capacity as well. Let's say tomorrow the company is bankrupt, then both the partners are liable to pay back for the losses that company has made, right? And the private properties are also into risk. So only if you have a very strong bond between partners and you feel that there is no conflict going to arise between the partners, then you should go for that. If you are at a point where you feel you are testing a startup idea, you don't even know that whether you are going to build a startup in the long run, and if you are aiming to be very big in time to come, then you should. So if you feel that your firm will not go beyond certain limit or beyond certain scale, then you should go for a registered partnership firm. But in my opinion, if you are committed to build a startup and expand your horizons across the states, I think you should go for private limited company, because even if compliances are there, the compliance has to be met by your CA, and you need to just follow up with them. That's it. Only part is little costlier, but I think it is worth to go with private limited, provided you have a long-term vision. But if you are still in a phase where you have not decided to run a startup, but you're still trying to have a side projects and all, then go for partnership firm. So now once you have registered the company, and if you have all these 5 parameters in place, validated, then you can apply for startup with Startup India team, DPIIT. How do you do that? You go to Google after the company registration that you have done. Go to Google, search Startup India, and then you can see here it is DPIIT recognition. You can click on that. You will see the screen. click on get recognition button, and there is an online form that you need to fill, and fill all the details that is asked in the online portal. The Startup India team will verify all these 5 parameters that they have mentioned in the eligibility. They'll take around 48 hours to verify those, and you will get certificate of incorporation in 3 to 4, certificate of recognition in 3 to 4 days, I think. And this is a certificate that you will get from Startup India team that so and so company is now incorporated at so and so time, is recognized as a startup from this date, and the certificate is valid for next 10 years. So you'll get the certificate. So I think I have I have made it clear about what is the process of registering a startup, what are different company structures available for you to decide which to choose, and what are the different benefits of choosing one over the other. So with this, I really wish you all the best for future. Thank you so much.